I am Puneet Khurana with my very good friend Manish Thakkar, and together we bring you Stoic Podcast Series. This series is started as an initiative by StoicInvesting.com to bring the best minds of investing to teach their wisdom, irrespective of their investment style or philosophy. Learn the various viewpoints, choose the nuggets, and then develop or enhance your own investing style. We have a very special guest for this podcast today. He's a man who loves reading, and we sincerely cherish it ourselves. He loves listening to music and he plays chess. But most importantly, he loves reading about companies. A man of few words, and we are glad that we have forced a lot more words than we were hoping for. We are glad to present Rajeev Thakkar of PPFAS Mutual Fund, who diligently is carrying forward the legacy of late Mr. Parag Parekh. Please sit back and enjoy our conversation with him.
First of all, a very warm welcome to the show, and thank you for taking out the time for the interview.
Pleasure being with you. Thanks for having me.
To start with, can you give us a brief about yourself, Rajeev, for our audience, your background, introduction to this industry maybe, and your days spent with legendary Parag Parekh?
Okay. So as such, I've been a Mumbaiite all throughout, born and brought up in Bombay. Basic education was in terms of commerce graduation, chartered accountancy, cost accountancy, and later on CFA. The reason for interest in the financial markets was, I think, twofold. So one, my father has been an equity investor since 80s. So when I was about 7-8 years old, I would see annual reports coming in at home, and one had that grounding, meaning investing in companies and so on. And he was an investor in the true sense, meaning buy and hold kind of person, not a trader. Of course, he did not have any sophisticated framework, or he had not read Benjamin Graham or anything like that. But his basic idea was in terms of buying shares and hanging on to them.
Right.
And as I was graduating, so my graduation year was 92, and that was the time when the Harshad Mehta frenzy for equities and all of that was there. Also, that was the time when the country flirted with bankruptcy, and then we went out and opened up our economy and things like that. So the message from my family to me was complete your education, you have sustaining power, and then do what you want kind of thing. So that was the reason for doing chartered accountancy. But the lure for financial markets in terms of a place where something exciting is happening and where wealth can be created was there. There was a Pied Piper who was drawing a lot of people in.
Right.
So that's how I ended up in the financial markets.
So Rajeev, was your first job directly into equity markets, and who all you started your career with?
Okay, so I graduated in 92, and one has to do a 3-year training period for chartered accountancy.
Right.
And one can do 3 years with a chartered accountancy firm, or one can do 2 years and do the 3rd year in a manufacturing or a financial company.
Right.
So I did 2 years of chartered accountancy, and 3rd year itself I ran away to a financial firm. I joined Prime Securities as a trainee. So Prime Securities is nowhere at the top these days, but in those days it was a company promoted by Great Eastern Shipping and was well capitalized for its time, and was in investment banking and stock brokerage and proprietary trading and various things. So that was where I started off. So 94 to 99 I was there. 2 years after that I was doing, so in Prime Securities I was in various fields, in merchant banking doing IPOs, corporate finance, doing some fixed income securities and so on. 99 to 2001, again I was doing fixed income securities with another broker, Bimal Gandhi. And 2001 is when I joined Parag Bhai, when I joined PPFAS.
So before PPFAS, you had an exposure in almost everything from bonds to equities, or equities
Yes.
didn't happen at that time.
So equities, I was not running a book, but
Right.
the IPO process was in terms of understanding a company, valuing it, talking to the promoters, then talking to the investors as to why an investment makes sense and things like that. Also interacting with the research team. So equities was part of it, and bonds also. So both sides of the spectrum.
So in
So,
equities, you are on
Rajeev,
the other side where you learn what not to do later on, basically IPOs.
That that that's correct. So in IPOs, I was not responsible for staking out our money,
Right.
but I had a ringside view of what was happening on the prop book. So there, like Munger says, you should learn not to pee on an electric fence by watching others.
Right.
So
Right.
it was a company which used leverage to buy equities, and when equities went down, there was trouble because interest meter kept ticking and there were principal losses and things like that. So I saw what leverage or what derivatives can do to investments, so or can do to your capital. So how not to do permanent loss of capital was something that I learned there, you can say.
Hmm. And Rajiv, tell me one thing. At that time, I remember the interest rates used to be very high. So was equity considered to be as good an alternative to debt as it is considered now?
So that was primarily the reason for moving to debt on my part. So
Okay.
this was mid to late 90s. So 1994, 1995, you had a government borrowing money at 14% per annum.
Wow.
And you had AAA corporate names borrowing at 18% per annum.
oh boy.
And you had the likes of Sardar Sarovar Nigam and NBFCs like Reliance Capital and all that, giving 21% rates to the depositors.
Wow.
So, given those kind of rates and given the fact that bond market was at a very nascent stage, then I felt that there was something interesting going on in the bond markets. So, while I keep saying market timing is not such a great thing to do,
Right.
but I joined bonds in 95, and I was in bonds till 96, and I was in bonds till 2003, and that was the biggest bond run period, bull run in the bonds. And when I came in equities in 2003, that was the beginning of a bull run for equities after 11 years. So,
So you timed it very well for your career though.
by sheer accident, I timed both the moves well.
Great.
So what are you doing now?
I'm still in equities, so I'll let you know if I move to some other asset class.
Okay, talking about asset classes, let me ask this question, which is in my mind for a long time. When Parag sir and you guys decided to go into mutual funds, what was the decision there? Why mutual funds? Why not a PMS or a AIF route or that kind of a structure? AIF was not there, but yeah, PMS at least would have been an option.
Sure. AIF also, the early signs were there that it was coming up, so
Yeah.
that also was an alternative.
Sure.
For quite some time, we had been hitting up against a wall in terms of having issues in the PMS structure. Now, as such, both are different vehicles to participate in the same asset class of equities. But there were some changes which happened. So, for one, for the clients, the entry level went up from 5 lakhs to 25 lakhs. So, the potential client base shrunk dramatically once that thing was increased. Also, onboarding clients was difficult. So, at that point in time, to onboard a PMS client, one would require a new bank account, new demat account, new brokerage agreement, custody agreement, PMS agreement, and it would take anywhere between, let's say, 60, 65 signatures for a resident client to 100 signatures for a NRI client. So onboarding clients was difficult and it would take its own time. So you couldn't do everything simultaneously. You needed to open the bank account first. Only then the demat account would get opened and so on. So it would sometimes take a month to onboard a client. Right. That was the second issue. Again, as such, the law is clear. If you are an investor in equity and if you hold shares for more than a year, your capital gains are tax exempt. But at that time, there was this term tax terrorism, which was coined and things like that. So if tax guys had a target to meet and they would say, no, this is your business income, and try and force clients to pay up some tax, and then clients would get it back on appeal and things like that. Right. So for various reasons, there were some hurdles in the PMS space. Mutual fund that way was something which was scalable. So in PMS, we started with somewhere about 35 clients when I took over in 2003. Right. We had gone up to about 650 clients. So each client requires one more demat account to be reconciled, bank account to be reconciled, audit to be done, and so on. So as we were scaling, we felt that mutual fund would be a better vehicle to manage investments.
Okay.
Understood.
Right. So Rajeev, you said you decided on the mutual fund route. I wanted to know, in an age where mutual funds have around tens and hundreds of schemes these days to lure their customers, you guys have just been consistent with one.
Yes.
My first question is, I would like to know the rationale behind that, and then I'll come to the second question later. But first, can we have the rationale behind it?
Sure. So, see, I'm sure there may be reasons for maybe having more than one schemes. Sometimes the asset class may be different, or sometimes the strategy may be different. But in our case, firstly, we are focusing on equity right now. So we are not into fixed income security. So that's one reason why we have an equity scheme. Also, many a times the schemes which have been launched in the past by some people have been driven by what will sell in the market rather than there being a sound investment rationale for that.
Sure. Right.
So if you look at the past, wherever there were some sectors or themes which were giving good returns in the marketplace, you would see a lot of schemes getting launched in that space. Exactly. So at the time of technology, you had the tech funds getting launched, and in 2006-07, you had infra, commodity, real estate funds coming up.
Right.
So our thing is that if the scheme that you are running has flexibility to go across market cap, across sectors, and in our case even across geographies to the extent of 35%, so in which case there's no reason to come out with a flavor of the month kind of scheme. Whatever opportunities are there in the marketplace, you can avail of in that single scheme that you are running.
Right.
So that's been our logic. We have kept the mandate flexible, and any opportunity which comes our way, we avail of that in this single scheme. And again, we even have this philosophical question that if an investor is sophisticated enough to sift through maybe 600, 700 schemes and then select one, then that investor probably is capable enough to select stocks, select individual stocks. So I come to a mutual fund in that case.
True. And my second question is related to that, Rajeev. I would like to know if this ethical behavior has hurt sales for you. I mean, I'll tell you what I mean. If you have 50 schemes, none of them would do well invariably, as the luck would have it, law of averages. Yes. And from there on, you can simply beat that trumpet to generate sales, forgetting about the laggards. Whereas if you have just one scheme, all of a sudden the spotlight is on you, on that one scheme. And so your accountability increases manifolds.
True. So that will remain for a while, but I think gradually people are becoming smarter. People are realizing that there's a thing called survivorship bias and things like that, or a lot of people have burnt their hands. So we have seen an era where a close-ended fund was trading at a huge premium in grey market when it was launched. A 10 rupee unit was trading at 20 rupees even before the scheme started investing. So people have gone through all of that, and I think people are now realizing that just having NFOs does not really add to investment performance. So we are happy to be under scrutiny. We are happy to be answerable to people. And also, since our own investments are here, mainly we are doing it for the joy of investing. It's something that we love doing, and we want like-minded people to be with us. So the goal is not necessarily to be the biggest, and I don't think, or I don't expect that we will be among the top 5 or top 10 anytime soon.
Sure. But Rajeev, tell me one thing. So when a client comes to you, invariably sometimes it will be in his interest for him to be, diversified between debt and equity. So do you take that kind of advice into account, and then divert him to good debt funds, or how does it work? Because you are purely equity. So how does it work for you when you're recommending a client?
Sure. So we are not in the debt space, and anyone who has an allocation for fixed income should, to the extent of that allocation, look at third-party products, be it fixed income mutual funds or tax-free bonds or whatever suits the particular client.
Right.
We are happy to recommend third-party mutual fund products to such clients. We surely think that, especially for certain clients of an advanced stage or people who need regular income, should have fixed income allocation, and equity as an asset class is not for generating month-to-month cash flow. So, in fact, for that reason, in our equity scheme, we don't even have a dividend plan, because having that plan would create expectations, or would create an impression among people that, oh, you can put money here and expect a regular return from this asset class.
Right.
So I think we are clearly not geared to offer fixed income products as of date, and we are happy to recommend third-party products.
Understood.
Right. In fact, not just the dividend. I also noticed that you set the expectations very beautifully by making sure that the client who joins in for at least 3 or 5 years, right?
5 years, minimum 5 years, yes.
Right.
So you're very clear on the fact that you're okay to lose the size when it comes at a cost, and for the simple factor that you want to have a lock-in period, and simultaneously you don't want to go beyond equities, which you clearly understand very well.
Yeah, so we don't have a lock-in period per se.
Right.
Clients can redeem if they want, but we clearly say that it's not suitable for people who have investment horizon for less than 5 years.
And just out of curiosity, how many people actually withdraw beforehand?
So it's not a very large number. I don't have the number offhand, but it would be less than maybe 5% of the clients. 7%.
Oh, that is not industry normal.
So what we have done is, at a time when many people have zero exit loads, we have put in a 2% exit load for exit in the first year, and 1% exit load if it happens between 1 and 2 years. Now this load does not come to us as asset managers. That load goes back to the scheme, and it's for the remaining investors, people who stayed in. So it penalizes market timers and people who come in and go out frequently, and it rewards people who stay for the longer term.
That's nice to have.
Rajeev, is that an industry practice, or is it only you guys are doing this?
So exit load, wherever it is there, has to be plowed back into the scheme across the industry.
Sure.
But a lot of people, to attract clients, say that, we don't have any exit load, so you can come and go out anytime.
Right.
So, we have felt that giving that kind of a message actually encourages some short-term money.
Understood.
So just as a thought experiment or whatever, if you were to enter and exit mid-cap stocks directly, you would pay some impact cost, you would pay brokerage, you would pay SCT. Whereas if you were to do the same in a equity fund with no exit load, then you would avoid all of that and you could market time in a mutual fund. So without any short-term exit load, mutual funds can potentially become a magnet for market timers where they can come and go out and take event-based calls.
ETF serve that purpose in US at least.
True. That's true.
Right. So, as he bought in US, I wanted to ask one thing. You guys have a very substantial portion towards US. I think close to 25% in last filing.
Yes.
So, I wanted to ask, and this was a question shared by a couple of people. Where do you think your edge comes from when you invest in US markets, considering the fact that you have been in Indian market for a long period of time, and over a period of time you have understood the businesses and all that stuff? Where do you think your edge in US comes from, and then why such a huge allocation to such a huge market?
Sure. So typically people say that if you are a resident of that country or if you are in that market, you would have an edge over the others. So for example, we should be having an edge in Indian stocks and someone residing in the US should have an edge in US stocks. So when we look at it that way, then if we take that logic forward, then each person should invest in their own market and should not go across the borders. So FI should not be coming here and we should not be going to the US markets. Or one should have local asset managers in every country that you are investing in.
Right.
So when we are going to US, we are not investing in any niche company in US.
Right.
And let me give you an example. Let us say a Westerner is investing in India. Now, for that person to understand a company like Dabur or to understand a company like Marico is very difficult. Like a Westerner will not understand what a Chawanprash is or why people put heaps of coconut oil in their hair. It's not a cultural phenomenon in the West. Similarly, if we are investing in the US, some niche US business, I would not be able to understand. But essentially, when we are investing abroad, we have said that we will invest only in countries with English language reporting. That is number one.
Okay.
Number two, we will invest only in countries where there's a strong governance mechanism, where there's a history of protection of shareholder rights, where accounting is fine, audit standards are great. So we are not going to Russia, China, Brazil, all over the place. It's essentially either US based multinationals or European companies, Western European companies.
Okay.
And the companies where we have invested in are companies with which we are familiar. So if you are investing in Nestle India, the business that Nestle's parent company does is very similar to the business that Nestle does in India. Or if we are investing in, let's say, IBM or Google or Apple, we know what those companies do. We know what 3M does or what a UPS does. It's not that we require any special insight into these companies. And with technology, we are able to access their investor communications almost simultaneously as US locals have access. So whether it's a investor presentation or a conference call, we are able to participate in those. So we don't think that it's so much of a disadvantage investing from here. What it does is many a times it gives you a perspective. You can compare and contrast those companies with our companies, sometimes avail of valuation arbitrages, have some diversification which reduces overall portfolio volatility and you don't go all over the place and things like that. So see, also today whether we like it or not, we are in a globalized world. So if you are buying Tata Motors, you are anyway buying into Jaguar Land Rover.
Right.
So you need to be aware of what is happening in the European car market. If you are buying Tata Global Beverages, you are buying into Tetley. You are buying Hindalco, you are buying Novelis. So as such, we are globalized. Even let's say our IT or pharma companies have a huge amount of exports to Western markets. If you are looking at Infosys, Wipro, TCS, you should be aware of what is happening with Cognizant. So even otherwise, you have to track what is happening overseas.
Right. Sure. Rajeev, and in fact, we were having this conversation with Mebane Faber of Cambria Funds, and he shared the same thing. He said, something like overseas investment is almost a must because that removes the home country bias and gives sanity to your portfolio.
True.
Right.
So Rajeev, tell me one thing. How do you hedge your currency risk at all, if at all you could do?
Sure. So about 90% of the value of the underlying portfolio, we hedge using exchange traded futures contracts.
Okay.
So let's say if we have $1 million worth of exposure to US stocks, we sell $900,000 in the futures market in India.
Okay.
So what kind of cost does that come to, this hedging?
Actually, that's the interesting part. So a foreigner who invests in India and who has to hedge the currency risk has a cost. And when we are investing overseas and when we hedge the currency risk, we get an income out of it. So we get an income of about 5 to 6% on an annualized basis.
Oh,
so
interesting. In fact, I was just going through the Infi results today, and I came to know that even they ended up making a profit through that hedging. But that's not guaranteed all the time, right? There can be losses at times too.
No, so I'll explain how this works.
Yeah, please.
Say interest rates in India are 7% and interest rates overseas are, let's say, 1%.
Right.
So there's an interest rate differential and the futures market are priced in such a way that there is no arbitrage.
Right.
So given the fact that Indian interest rates are higher than international interest rates, rupee will trade at a discount in the futures market. If the spot dollar rupee is, let's say, 67, a 1 year futures dollar rupee would trade at, let's say, 71 or 72, wherever it's trading. So this price is available on the NSE website and so on.
Right.
So let us say you do nothing else. You just buy $1 today for 67 rupees and you sell $1 in the futures market at 71.
Right.
You keep that $1 in the current account abroad and after 1 year you bring it back. So you get that 4 rupees or 5 rupees on the futures discount that rupee trades.
Right.
We do that same thing, but instead of keeping that money in the current account, we go and buy equity shares from that $1. So we hedge out the currency risk. We are not, to the extent of 90%, we are not concerned whether rupee appreciating or depreciating. We have no underlying strong view on the currency per se. We get the dividend yield wherever it's a dividend paying stock. So some companies like Nestle have a 2.5-3% dividend yield. If you end up making, let's say, 5-6% on the currency hedge, then you get whatever between 7 to 9% fixed income like return on the underlying equity share, and whatever capital appreciation, depreciation comes is over and above that. So of course dividend yields change over time, forward discount will change over time, but this is as it prevails today. And to your question that does it always work in this fashion? So as long as Indian interest rates are higher than overseas interest rates, rupee will always trade at a discount in the futures market. How much discount will depend on interest rate differential.
Sure.
So in theory, if let's say Indian interest rates were to come down to 1% and overseas interest rates are also 1%, then there will be parity. The spot exchange rate and the futures exchange rate will trade at the same level. So it really depends on the interest rate differential. But given that inflation in India is higher than global inflation, given that our interest rates are higher. This relation has held true for at least as far as I can remember, last 20, 30 years, 40 years.
No, so Rajeev, if I understand this correctly, this relationship is not based on interest rate differential, but the timing of that interest rate differential, isn't it? So there can be a situation where you are caught on the wrong side of the trade if for that particular timing for which you are holding the contract, the rupee is appreciating or depreciating.
No, it's not. So it's basically today what is the 1 year interest rate for US dollar deposits and what is the 1 year interest rate for a rupee deposit. As long as our interest rates are higher than overseas interest rates, we will be trading at a discount in the futures market. So very simply, you can go on the browser, go to the website, check out the current interbank rate for dollar rupee, and on NSE's website, check out the 1 year contract rate, and that difference is positive. So as long as you are doing both legs simultaneously, there should not be any impact on where the exchange rate moves over a period of time.
Understood. I think what you're saying is, Manish, there'll be an impact on the quantum of the return they're going to get out of it, but it might not be on the negative side. Am I right, Rajeev?
So the extent of the discount or discount will vary. So sometimes you may get 5-6%, sometimes you may get 3 or 4%.
Yeah, that's
but you do get that return.
Fair enough. So that compensates for you investing into US equities also, which inherently has a lower equity return compared to Indian markets.
That's correct. So people compare dollar returns and rupee returns, but that's not the right way to look at it. You have to take it in a uniform currency both ways. So that's the correct way to look at it.
Right. So Rajeev,
So just to give you an example, I've just pulled the data on my screen.
Yeah.
So on the National Stock Exchange platform, today's rates for dollar rupee 1 year out are 70.78.
Okay.
And the spot is 67 point whatever for 10, 12, wherever the rupee is. So
67.06. Yeah.
Yeah. So if right now you buy at 67.06 and if you sell 1 year out without doing anything, you can get this spread.
Okay. Understood.
Rajeev, at your mutual fund, what is your modus operandi for stock selection? I mean, I know the fund follows the tenets of value investing, but within that, what is the subset? Do you look for cash bargains, Benjamin-style cigar butts, or do you look for growth at reasonable prices?
So this is more like Munger and Fisher kind of value investing rather than pure Benjamin Graham cigar butt kind of thing. Of course, we do have a couple of stocks which could get classified as Benjamin Graham. But see, what happens in India is that you don't have too much of a tradition of activist investing.
Right.
And Benjamin Graham kind of thing really would work if someone like Carl Icahn comes and threatens the board or demands a board seat, saying, why are you holding on to so much cash, throughout cash, or this division is loss making, or discontinue these products and create value for shareholders. There needs to be some catalyst for a pure Grahamian approach to work.
Right.
And a scenario where the promoters own 50, 60, 70% of the company, they don't really care for outside shareholders. So if the business is inherently low return on capital business, even if it's a cash bargain, you will never be able to touch the cash. And many a times what happens is, instead of the price going up to intrinsic value, sometimes the intrinsic value falls below the share price if the capital is misallocated.
Sure.
So we are more towards buying quality companies at reasonable prices rather than cigar butt investing in that sense.
Rajeev, you just said that the activist investing is not very prominent in India, and there have been very, very few cases in past where outside investors have tried to become activists. Even though slightly I have an idea, but can you briefly tell what do you think is the main reason why we don't have activist investing, and I mean, how can it change, if at all it can change?
Fear of death, I say.
So how can it change, if at all it can change? What from regulatory side, what can be done? Do you have your point of views there?
Sure. So there have been incremental changes over the years. I think a lot of necessary conditions are coming in. Maybe it's still not reached a sufficient stage. So I think the first catalyst was moving to a demat kind of share trading. So earlier in the physical shares, when the buyer lodged the shares to the company for transfer, the board of directors of a company could reject the transfer, saying we don't want to allow you to buy the shares. So that is history now. Now anyone can go out and buy shares on the exchange, and the company will be forced to transfer the shares. Also, you have these thresholds where if you cross a certain percentage of shareholding, you have to launch an open offer and things like that. So those conditions are there, and one would say that we are ripe for activist investing kind of thing. Again, New Companies Act allows or requires a lot of related party transactions to be put to vote, where promoters cannot vote on the resolution and things like that. SEBI has made it mandatory for mutual funds to vote on resolutions and disclose their actions on the website. So all those are positive developments. You have shareholder advisory services, 3 of them launching in India and making recommendations. I think final stumbling block is the high promoter stakes. So no amount of activism is going to work if the promoter owns 75% of the company. So with maybe 10, 15, 20%, how much can you influence the decision?
Sure.
So what we have seen in India is value unlocking happening, where the second, third generation of the promoters, the family does not get together well, and they split the company and go their own way, and some unlocking happens. That's what we have seen in India so far. We still haven't come to a situation where the promoters own maybe only 5, 10, 20%, and then you have these corporate traders and activists coming in.
Sure. So Rajeev, let's for the benefit of the listeners as well as for our own benefit, let's just go through the complete process you go through while selecting a particular stock, right? So you said quality at reasonable price is what you look for. So
Sure.
do you use any kind of quantitative screens for that, or by the very sheer network of people you are in touch with, your screening process has gone down? How has the screening process for the companies evolved over the years you have worked?
Sure. So the starting point for a company getting into a consideration list can come through various routes. So one way would be we are running a screener on all the companies, and something looks interesting. That is one way a company could come to us. The other is we track what other investors are doing, investors who we respect, and if they have done some portfolio actions in terms of buying certain companies, we would look at what's happening there. It could be a media article where someone is profiled or interviewed, or some story comes out. Starting point could be anything. In terms of the parameters, there are qualitative parameters and quantitative parameters. So qualitatively, firstly, we want some background of the promoter. So if it's the unknown promoter entity coming out with the IPO, we would give it a pass, wait for their behavior as a listed company to be there with the people for some time, and then consider investing. Otherwise, if the promoter group is well known and they have had a good history of treating minority shareholders well, then that would come under consideration. So management quality, promoter quality is the first filter,
Sure.
which is essentially of a qualitative nature. Quantitatively, we would want a good return on capital, low debt, decent amount of sales growth, where there is potential for the company to grow rather than to be a static kind of thing.
Right.
So those are the kind of filters we would run, and then you'd narrow down the overall list of companies under consideration. And even companies with good promoters, good management, and good business characteristics, most of the time these companies are expensive. So typically one would watch these, and if for some reason they are available at attractive valuation, you would go out and buy those.
Sure. So Rajeev, a lot of things which you said in that particular statement, I have just noted down few questions. So first thing you said is most of the time these companies are available expensive, and that part is well clearly understood. I was going through your portfolio, and you have some pharma companies going through FDA troubles, and
Yes.
a tire company with a huge amount of negative growth for some time now, and problems in Europe. So not negative growth, but yeah, stagnant growth. So so are you looking for those temporary trouble kind of situations to buy into, or are you still willing to pay premium for quality and buy them at their normal, routine prices, and then just hoping for the business to keep on running the way it is running? So where do you line in the selection criteria?
Sure. So opportunity can come in two forms. So one is where a company is going through certain trouble. So in the international context or in terms of academic literature, Amex going through a salad oil kind of scandal, where you don't see it as a life-threatening thing, or you expect that the company will come out of its trouble, and it's a temporary thing. So that is one opportunity. The other opportunity set comes where the entire fancy is elsewhere. So the next big thing seems in a new sector, and the market tends to ignore the consistent performers. So we have seen this happening in, let's say, the FMCG space in late 90s, where everyone was chasing the TMT or IC or whatever you call new economy shares, and old economy was not glamorous. Right. We saw that again happening in 2006, 2007, where entire fancy was in infra, commodity, and real estate. And again, you saw pharmaceutical companies getting ignored, and you saw FMCG companies being ignored. So sometimes there may not be any company-specific trouble. It may just be that the market fancy is elsewhere, and you get opportunities there.
Sure.
Right.
And other cases?
So see, if the company is in a fancy valuation, then it doesn't make sense, especially for people like us, to buy into them, or in some cases even hold on to the stock. I'll give you an example. So let's say, without naming any particular company, let's say a company was at 20 times earnings. Now that company has been growing earnings consistently at 15-20%. Right. But if the stock prices run up 5x, 10x in a short span of time, and the company is now trading at, let's say, 70 times earnings or 80 times earnings, you cannot buy a company at any price or even hold on to a company, because in a open-ended structure, any client putting in money today is effectively buying the shares at the current valuation. You cannot then justify saying that, oh, my purchase price was much lower, so I'm continuing to hold on to the stock. Then wherever there's a possibility of a big loss of capital, then you should move out of such companies. So we don't chase companies in that sense, or we don't buy at very high valuations. We are conscious of the price that we pay.
Right. That is great. So this is your selection criteria, Rajeev. What is your sell criteria? When do you exactly sell, and what is your average hold period?
So sell decision is always much more difficult than the buy decision. So in buying, you have selected quality promoters, you have selected quality business, and you have selected an attractive entry price. Now, if things go right for you, the first two things remain. It remains a quality promoter, it remains a quality business. Only thing that changes is the valuation, and it becomes very expensive. Again, I am not in the camp that believes that intrinsic value is a point estimate. intrinsic value is a big range of values. So
Sure.
you can say that intrinsic value is, let's say, between 100 and 200 rupees. I am not someone who says that intrinsic value is 125.36 rupees. You don't have that kind of precision. So let's say if your valuation estimate was 100 to 200 rupees and you bought it at 60. Now, when it moves from 60 to 120, you can hold on, 130 you can hold on, but if it goes beyond 200, then obviously even at your most optimistic assumptions, if it starts looking overvalued, then I think one is forced to sell. So that is one kind of a sell decision. If even your optimistic projections are met and stock is even quoting higher, then one would be forced to sell. The other sale decision is relatively easier, where it turns out to be a mistake, either your own mistake or because of industry or market developments, where either the business is not as great as you thought it was, or if the promoters start behaving funnily and doing actions which are undertaking actions which are not minority shareholder friendly, in which case one should sell out irrespective of whether one is making a profit or a loss, and one should just sell it.
So Rajeev, since you mentioned about mistakes, can you take us through some of the mistakes, especially on the front of analysis of business model? So I'm pretty sure psychological mistakes we keep on committing every now and then. But my question is primarily on the analysis of businesses. Can you explain with some examples where you have done some mistakes which really hurted you in the portfolio sense?
Sure. So looking at our own processes, I think one trend where I've seen a recurring pattern in my own mistakes, and hopefully I'll in the future move away from pattern, is wherever there is some potential for government interference, things haven't worked out that great.
Okay.
So in the PMS context, we were holding shares of the oil marketing companies, HPCL, BPCL,
Right.
and we were lucky to get out of the companies at close to our purchase price after 2 or 3 years of holding. If we had held on longer, we would have had capital losses and massive opportunity costs. So those were public sector companies where the government forced them to buy their raw material at higher prices and sell the finished goods at a lower price. Another thing where there's no financial loss per se, or it's moderate here and there, but there's a opportunity cost, which has been Noida Toll Bridge, which is there currently in our portfolio. Reason we are not selling is we think that it's already in the price, but essentially it's a infrastructure project, mature infrastructure project that we had bought, and where the company has not been given toll increases, which they are, which should come to them as per contract.
Right.
It's just that the people in that vicinity protest or whatever, and politically the government finds it expedient not to allow a toll increase. So essentially government renege is on the contract. So I think in India especially, and again I heard Mr. Ramdev Agarwal again say this in a different context. He said that people sitting in Delhi are socialists. End of the day, it's not a capitalist country in that sense. So wherever they can interfere or wherever they can tinker with, they won't allow business people to earn a profit, and they would want people to get things free. So I think wherever it's a PSU or wherever it's even a private sector company where government can interfere with the pricing, there is a potential for your thing not working out.
So Rajeev, are you calling it a mistake primarily because you underestimated these points, or?
I underestimated. So other than that, it's worked as planned, meaning they have repaid whatever little debt they had when I purchased. They have started throwing out cash to the shareholders.
Sure.
The disappointment has been in terms of toll increases not coming in as expected. So that is one. Another stock which hasn't worked out well for us has been in the investment management space. So this is Island FS Investment Managers, where the past track record was fantastic, and again, the business model is scalable. With the same team, you can manage 5x the assets and get more fees and so on. We got the cycle wrong and we underestimated the cyclicality. So the space where they were managing assets, which is real estate assets and infrastructure assets, both of them saw a cycle peaking out, and the asset raising really stalled, and even the exits got delayed, things like that. So these are a few stocks that haven't worked out for us.
Sure. And Rajeev, do you also see other good investors who continue to make some kind of mistakes in assessing business risks? So maybe something which you understand but you observe in other investors, they on the business assessment side, that they keep on making, or they underestimate some risks. Any such thing you have noticed?
Well, I'll speak for myself. I'm happy to admit mistakes that I have made.
Okay.
I'm sure everyone makes their own mistakes. But I think in the Indian context, so again, I've written an article in Mint on this. So people talk about, let's say, medical tourism, for example, saying hospitals in India undertake surgeries for a much lower cost as compared to overseas countries.
Sure.
And there's a big potential over there. Again, there's a possibility that government could intervene in terms of pricing and things like that. So one has to be cognizant of that risk when one is investing, because anywhere where there could be so-called public interest, or where you can argue endlessly saying it's a free country, the doctor is free to price his services as he wants and things like that. But ultimately, if there is a feeling that public is suffering, there could be price caps coming in or things like that. So,
Right.
I think in India especially, one has to be aware of the public opinion and sentiment. The pricing may not work out as one would expect.
Fair enough. So Rajeev, let me ask your thoughts on valuation. After you have evaluated the company, how do you go about the valuation process? Do you think more in terms of multiples? Do you think more in terms of DCF kind of model where you project the cash flows? What is your process?
So regarding DCF, I came across this wonderful quote, and at least in terms of my approach, it applies perfectly. So he says DCF is like the Hubble telescope. You move the telescope 1 inch and you are in a different galaxy.
Right.
So in DCF, so again, another quote from, I don't know who, but a brilliant quote. The person says that the best software for writing fiction is not Microsoft Word, but it is Excel.
Right.
So depending on whether you assume a growth rate of 15% or 20% or 25%, or discount rate is 12% or 8%, or terminal growth rate is 3% or 7%, you can get any DCF value that you want.
Completely.
And many a times when you do these big spreadsheet calculations, you end up fooling yourself, and possibly you are the easiest person to fool. So you can fool yourself because you will buy whatever argument you give yourself. Someone else will ask you questions. So when I think about valuation, I want, I think Stephen Penman has put this well, saying that in every stock there is a true intrinsic value or true fundamental value, and there's a element of speculative value.
Right.
The true fundamental value would be the cash flows you can see in the near term, meaning what is the present value of the assets on book, what is the next 4-5 years, 7-8 years of cash flow, and the speculative value would be what you hope the company will become. It will grow its business, it will expand, it will enter new geographies and things like that.
Right.
So you want to place as little in the speculative category as possible. You will never, you can't overdo it, so otherwise you will never be able to buy any company.
Right.
But effectively you want to not pay too much for fantasies or not pay too much for growth, but you want the existing cash flows to support the current valuation to a large extent. That's the approach I would take. I'm not too much into long drawn out projections or DCF in that sense.
So is it fair to say that you look for the built-in growth in the prices and then do the reverse calculations, if at all you're into calculations, or you tend to give away some kind of estimates on how much multiple the company should be trading? And so I'm still trying to figure out how do you pinpoint, okay, this is my fair price to buy this company at?
Sure. So if let's say one feels, looking at the current market price, that the market is pricing in only a maybe 5 to 10% growth,
right,
whereas there could be a potential of a 20% growth, then obviously you are not paying too much for the stock. Whereas in some cases it could be priced to perfection, saying market is already pricing in a 25-30% growth, and if the growth comes out to be 10%, then you would end up losing a lot of capital, and only if growth is, let's say, 30-35% would you end up making some money. So essentially you don't want to pay too much for fantasies or for huge numbers in growth.
Understood. And Rajeev, tell me one thing, once you have assessed the valuation and everything else, how do you decide your cash allocation, if at all you decide to keep in cash? And is market valuation a criteria while deciding the cash allocations?
Approach is complete bottom up. I don't have any view on overall equity market movements. So it's not that in 2007 I had a great insight that there would be a bankruptcy of Lehman Brothers in the US next year, or Bear Stearns would have problem and Merrill Lynch will have a problem. It's just that I was not able to understand what was happening with DLF Unitech, and I was happy to buy some FMCG companies and some pharma companies,
right,
and balance whatever one couldn't deploy was in cash. So it's a complete bottom-up approach. So in fact, to give you a recent example, people would have thought that if Brexit happens, then it would be end of the world for equities, and Brexit happened, and today we are at prices which are higher than pre-Brexit.
Right.
So there's no target cash allocation, or there's no macro view in that sense. Cash allocation would happen if there's some residual money. So if I'm not getting opportunities, or if I'm waiting for some opportunity, or there's still some work needed to be done on a particular company, it would lie in money market for some time.
No, fair enough. But when I said market, overall market levels, I'm not talking macro. But the only point was the valuation of markets. So, for example, and this to contrast with another mutual fund, specifically I'm talking about IDFC, who gave a PE-based, a tool to investors to decide whether to put more money into markets or less money into markets. What is your view there? Do you, as an asset manager, give any heed to market valuations? You may not obviously give a large amount of heed because you go bottom up, but do you take it into consideration for any kind of call?
So what IDFC does is, it's obvious that if you buy when things are very cheap, your returns in the future years will be good, and if you buy when things are very, very expensive, then obviously your returns in the coming years would be lower.
Sure.
And you would have to end up holding your investments for a longer period.
Sure.
Now, this would be the right approach if one was doing index investing or large cap investing, or one would broadly own the same stocks that Nifty would have, or things like that. But if those signals, those green, yellow and red signals are coming from a Nifty valuation or from a Sensex valuation, and if your individual investments are not part of that basket, then it would not be such a relevant criteria.
Sure.
So again, going back to 2006 or 7, ITC, when Sensex was at 17,000-18,000, was available at somewhere around 160-162, and when market went up and crashed at the time of Lehman bankruptcy, index fell by more than half. You saw ITC going up in that period. So if even at a elevated market level, if you are getting bottom up stocks which make sense, one would go out and invest. Same thing again at the time of .com boom. So Infosys or a Wipro was overvalued at that time, but the so-called old economy shares were available at attractive valuations. So finally, I think again what IDFC does is if one is not getting opportunities, one should shut the doors for fresh investments. One should not collect more money from investors. I think that makes sense. And if one is not getting opportunities, one should be in cash temporarily.
Sure.
We are happy to do either of those two, but we don't go so much by index levels because our mandate is much broader than the just the Nifty or Sensex.
So, but you're comfortable, so you drive your risk management or the comfort levels by selling at premium valuations of the stocks you hold rather than anything else. Is that a correct understanding?
Yeah, that's correct.
Okay. So another thing which I wanted to ask is that you mentioned that you read some media articles to come up with your investment ideas. Would you be willing to recommend few magazines which you think are good for every investor should be reading? I mean, besides The Economist or The World, any magazine specifically which you want to recommend?
So it would be the business magazines that are there, rather than looking at magazines which give economic stuff or which give political news, etc., or even reading the daily business newspapers. I would rather spend more time on business magazines like, let's say, Forbes or Business India or Business Today or Outlook Business and things like that, where different promoters, different companies are profiled, their journey over 3, 4, 5 years is described, their future plans are discussed. So things like that.
Sure.
Right. Rajeev, as you were giving the answer for the question when Puneet asked about your way of selecting the stocks, I came to know, and correct me if I'm wrong, your selection is a lot less to do with the quantitative aspects of it, but a lot of qualitative and subjective in nature. I wanted to know, value investing, since it's not necessarily a science, and so decisions can be very subjective in nature. How do you ensure that the legacy continues?
So it is also quantitative in a sense.
Okay.
It's a mix of quantitative and qualitative. So would I invest in a business which has generated, let's say, 6% return on equity consistently for a decade, and where I see a temporary upswing, but again, fundamentally the business would not change, and that is ingrained in the team and in the organization, meaning we don't want to invest in wealth destroying businesses.
Right.
So leverage, return on capital, margins, all these are quantitative things. The place where quality comes into picture is that, one, there is a stress on promoter quality, management quality, and we don't want to partner with people who cheat minority shareholders or treat them badly. That is one qualitative aspect. And second is we don't do too much of detailed projections, because then that gives you a false sense of comfort. It gives you precision where none exists. So that's the art part of it. Science, of course, is the quantitative aspects, which is you don't want a very leveraged business, or you don't want low return on capital businesses.
Right.
So as far as the team goes, we interact quite regularly. We discuss each idea. So whenever an analyst has an idea to talk about, it's not one-on-one with me. We discuss it with the entire team. Everyone puts forth their point of view or brings out their questions, and we brainstorm it. So the thought process is shared with the entire team as to why some stock is there or not there in the portfolio.
Yeah, but Rajeev, I was more concerned towards, my question was primarily how do you communicate the same thing to the investors, primarily because, and I asked the same question to Mr. Parekh also that day, that a mutual fund's process is not known to the world, but the mutual fund manager is known to the world, right? So a large amount of inflow essentially is an outcome of the reputation of the manager. So for example, Kenneth leaving IDFC or the sudden and sad demise of Mr. Parekh, does that create too troubles with investors? Internally, I understand the team would know the process and everything else, but how do you communicate this to the investors?
Sure. So, multiple things. So, one is that every year we have what we call AGMs with investors in three cities. So, these are not statutory meetings. There's no SEBI mandate to do this or no compulsion to do this. But voluntarily, we say that one day in a year, we will have our investment team, we'll have the management team there to answer any and every question that an investor or a distributor partner has for us.
Sure.
So it could be on different stocks, it could be on outlook, it could be on cash holdings or investment process and things like that.
Sure.
And also at one of the places we record the session and we put out those question and answers on the web so that people who could not attend it in person can figure out what transpired at the meeting.
Sure.
Apart from this, we have a monthly session for a few Rotarians where we discuss various sectors and companies. It may not necessarily be something which we have invested in. It could also be companies where we have not invested. So it gives some exposure to the thinking process that we have and how we operate. So wherever possible, we try to keep those communication channels open and ensure that only the like-minded people come in and people know the process rather than the individuals.
Right, great. So next time when you're doing this in Delhi, please let us know. We'll be glad to be a part of that.
Sure. So as of now, the three cities are Mumbai, Bangalore, and Chennai. And the reason
why
for
this
these
injustice to Delhi?
So the thing is completely in the hands of Delhiite.
Okay.
What we do is we go to the top three markets in terms of number of clients.
Oh,
And it just happens that these are the three top cities for us as of date. So a lot more people from Delhi will have to become unit holders for us to shift from one of the markets.
A lot of traders in Delhi rather than value investors, huh?
We do have clients from Delhi, but as of now, it's at number 4. So there is some amount of...
Then I think you should start doing top 4 cities rather than top 3.
Yeah, maybe we'll do that.
Sure. Great, Rajeev. It was pleasure talking to you. Thanks a lot. Manish, any questions?
That's it from my side too, Rajeev. It'll be nice if you could recommend us some names that you would like us to file in our podcast.
Okay.
Hello?
Yeah, Rajeev.
Hello? Yeah,
Yeah,
I couldn't hear you or somehow it got disconnected.
Okay. Anyways, I was just thanking you for giving us time today. It was a pleasure talking to you. And Manish wanted to ask something.
Yeah, I just wanted to ask one last question, Rajeev. I was wondering if you could give us some names that you would recommend us so that we could profile them on our podcast.
I think Chetan Parekh is someone you should talk to.
Okay.
He's someone who's typically not in the media. A lot of other people, you generally come across them.
Sure.
And
Sure.
Anil Kumar Tulsiram is someone, again, who would be interesting to listen to.
Right. He's a friend. I'm sure he'll say yes.
Mm-hmm.
On the contrary, he says that it's very difficult for me to give on-the-spot answers. But yeah, I'll talk to Anil.
Yeah, so a lot of people, so again, I'm not giving you names you regularly see in the media because then it's one more...
Yeah, it's just another interview which you
thing,
don't
yeah.
want anyways. Yeah, so
Yes.
that is not the intent. So great, Rajeev. Thanks a lot. Any other suggestions you have for us before we call it a day?
No, I think you're doing great work, and it's always interesting to listen to people who one doesn't usually get a chance to listen to, and it's good fun.
Great, thanks a lot, Rajeev.
Right, Rajeev.
So let's catch up next time when I'm in Bombay. I'll definitely come sooner.
Sure.
Sure.
Do drop by.
Yep. Thanks, Rajeev.
Thanks for your time, Rajeev. Have a good day.
You're welcome. Bye.
Bye.